little bit of a pullback, and I'll get more into that as we go on, but overall, the market trends, both on initial public offerings, follow-on offerings, and uplistings, the trend tends to do very well. Okay, the two sectors that have dominated the IPO market, both last year, and I'll say the second half of last year and this year, are healthcare and technology. You can see in the top chart there, the 44 deals that have gone priced, come to market in the healthcare sector. When I talk about healthcare, I'd say 90% of those deals tend to be biotechnology companies. And as I talk a little further, you'll see that the amount of capital tends to be lower than other sectors. 24 deals have been done in technology, and if you compare it year over year, you see a tremendous uptick in those two sectors. The other sectors have been fairly comparable in terms of last year and this year. And then if you look at the bottom part, you'll see on the proceed side, a little different picture here in that financials tend to be where most capital is migrated to, with technology being a close second. Healthcare being substantially lower, about a third of what's occurred in the financial sector. We have seen most of the IPOs being in what I call private equity or carve-outs of existing public companies. That's where we've seen the most activity. Although that being said, even when I say the biotech and tech sector has slowed somewhat, it's still on a record pace. All right, let's take a look at performance of the various sectors. And the way you look at the top chart here is within the months, starting in December of 13. And on the left side, you'll see the deal being priced on the below, and the medium is within the range, and on the right side, above the range. And what you've clearly seen, at least in the last 30 days, is that about 75% of the deals, although they're getting done, are being priced below the range that was anticipated or put on the reds. That being said, what you can tell is if you look at the performance of the various sectors, it paints a much different picture in terms of day one performance and year-to-date performance. You'll see that the industrials have done incredibly well, closely followed by materials and energy IPOs. The worst performing sector, truth be told, is healthcare, particularly on the biotechnology side. Now that being said, 2013 biotechnology in the last 6 months of the year was the best performing sector. There's probably quite a few reasons and explanations for it. What we have seen is, particularly in that subsector, I'll say, is that companies that are going to pre-IND or phase 1, those are the companies that now tend to be getting funded versus those companies in phase 2 or phase 3. And plus it's a sector, truth be told, that usually there's an endpoint that's defined in terms of can they get capital for the next raise. All right, what we have seen though in the pipeline, and we continue to see, is a continued uptick. And I think most companies are doing that because they want to be prepared for when the market is right. You can see in the top right-hand corner there, filing trends. And if you look at, say, the beginning of this year, January to date, the number of companies that have filed to go public has increased. It continues to increase. We continue to see that. Interesting enough, since the Jobs Act has been enacted, about a little less than 89% of the companies that have filed and gone public have utilized the Jobs Act as the primary method to go public. And within that, healthcare, technology, and consumer tends to be about 60% of all filings. So those sectors, even though they vary in terms of performance, they're the sectors that tend to, companies want to go public. You can see the breakdown in the bottom right-hand corner there in terms of subsector filings that are being made. Let's take a look at the U.S. markets. Obviously myself and my competitor NASDAQ. When you compare the two markets, what I'll say is that the proceeds being raised, clearly the New York Stock Exchange is the leader. And in terms of the number of deals, you can see it's fairly comparable. I will say year to date, as of June 2nd, we've had, that number's not 48, it should be 54. NASDAQ's had 77. About 75% of their deals have been in the biotechnology sector. But what's most interesting is let's look on the bottom side of follow-on capital, and clearly there, that's where you see record numbers being posted. So companies that are already public have been able to raise capital to execute on the business plan. What I will say, and I'll talk a little more about, is most people, when they think about the New York Stock Exchange, view it as a mid to large cap player. When in fact, when you look at the NYSE, it's comprised of two listed tiers, NYSE, NYSE MKT. And as Dodie had mentioned, the MKT platform initially got its funding, or I should say its grounds, through the acquisition of the companies on the American Stock Exchange. That was 6 years ago, and what we did as part of that transaction, we modified the listing standards on the NYSE platform. Prior to 6 years ago, in order to list on the New York Stock Exchange, you needed to have a market capitalization of at least $500 million or more. So when you think about it somewhat intuitively, there were a lot of sectors that when they first came to market or had the ability to uplist, simply just didn't qualify. They tended to be more in healthcare, technology, and what I'll say FIG. I'm pretty proud to say that as we talk more today, we've now recouped and become a pretty dominant player in those subsectors. I'll talk a little about the New York Stock Exchange, but then I really want to talk about the listing process and certainly answer any of your questions. I think there's 4 reasons why people look at the New York Stock Exchange. One is flawless execution and launch. I think you probably know that our market structure is a little different than all the other pure electronic platforms. First, let me say that all markets are electronic in nature. We, on the other hand, we overlay that with a floor-based model in which the pinnacle centerpiece of that platform is something called the designated market maker. Some of you might recall, historically, those people were known as specialists. I can tell you that the rule set has changed dramatically, where they are now market makers, just like any other market participant, with one key differential. The differential is that we mandate and we incentivize those individuals to commit capital. And that's the only way that they can get new allocations to new companies. So when you think about it, we're the only platform that someone's getting compensated to commit capital. So the return on investment is not on the quote spread, it's really on capturing the trade, which is a little different than most market participants. As you may or may not know, today in the equities world, there's in excess of 25 different platforms that investors can capture or execute order flow. A lot of it had to do with 2 rules that were put into place a number of years ago. One was regulation NMS, the other one was decimalization. And the concept behind these 2 rules were to create more competition and put suppression on the quote spread. What has transpired is on the high end, the large cap, it has lower quote spreads or tightened spreads dramatically. It's had somewhat of a material impact on the mid caps. It has not been very favorable for small cap stocks because it's fragmented trading across multiple venues. That being said, another thing that is occurring is the proliferation of dark pools. You may or may not know that dark pools were created to execute block transactions. Today, internalization of dark pools are used not only for the institutional side, but also for the retail side. What is encouraging is that the SEC, you probably read, has opened up a dialogue with a lot of these, what I'll call high-frequency traders, electronic computer networks, and all market centers to have an open dialogue about market structure. So we'll see where those dialogue and those discussions come out. I think the second reason why people look to partner with the New York Stock Exchange is our visibility platform. We're somewhat unique in that we have 37 news outlets live on the trading floor. That obviously gives us great branding as an institution, but it also gives the opportunity for our listed companies to get a lot of awareness and visibility too. Our service platform is a little different than other markets. We have a suite of complementary services that focus on 3 areas: real-time market intelligence, education, and corporate governance. We think it's important to educate our companies and keep them apprised of what's occurring not only in the stock, but in trends in the market. And then the last thing is right partner for the long term. Proud to say, and the last thing I'll talk about for the NYSE is that not only do we lead global markets in terms of capital formation, but more companies leave other exchanges to list on the New York Stock Exchange than any exchange worldwide. Talked a little about this, but I'll say is, again, we have two listing tiers, NYSE, NYSE MKT. They're identical. The only difference between the two tiers are the quantitative listing standards, which I'll certainly get into in a second. My competitor in the U.S., NASDAQ, has 3 listing tiers. The SEC mandates that exchanges tier companies, and for the most part, the only differences really are the listing standards. This touches upon the 2 tiers. I can tell you that in terms of quantitative listing standards between MKT and NASDAQ capital markets, they're identical. However, with a few different caveats in terms of penny stock rules and continued listing standards. I'd be happy to speak about that if anyone has a question on it.
Excuse me, sir.
MKT, as I mentioned earlier, we acquired the American Stock Exchange. In way of background, I came to the New York Stock Exchange via the American Stock Exchange acquisition. We rebranded the American Stock Exchange into NYSE MKT. We did a few things in terms of capital requirements for the designated market makers. We discontinued the technology platform Amex and now utilize the NYSE. So if you ever come down to the trading floor, you'd have no idea which tier a company trades on. A little different than how we handle it versus other markets is that we allow companies to list on either or tier, and we don't mandate that once companies are qualified to uplist to the next tier to move. In fact, a little less than 30% of the companies on MKT are fully qualified and choose to remain on MKT. Primarily because, as I said, it's identical and interesting. Of the 4 designated market maker units on MKT, they also have operations on the NYSE. So they can choose to move, they can choose to stay. About 86% of the listings on MKT are either through traditional IPOs, quotation or uplistings from the OTC markets, or companies looking to come into the U.S. markets and dual list. As you can see, the next bullet point a little different from what my competitor is. Technology listings, as I said earlier, tech has been a pretty hot sector. It's been very good in 2013, continues to be in 2014. You can see here that I'm proud to say that the NYSE captures about 63% of all tech listings. 2012, 16 of the 20 largest tech deals listed on the New York Stock Exchange. That trend continued in 2013, where we captured 54% of all tech IPOs, and year to date, we've actually captured 63. So, which is pretty amazing given the fact that 7 years ago we had about a 3% market share in tech stocks. I attribute a lot of it to the modification of the listing standards, creating the MKT platform, and simply being more aggressive. One thing I'll say about our trading platform is, obviously technology is a great enabler, but getting it right and executing trades in the proper manner is more important in today's environment. All right, let's talk a little about the listing process. When should you engage an exchange? And first, let me say, although I've been talking about the New York Stock Exchange a lot here, obviously, for a company looking to list, I think it's important that they probably meet with both exchanges and see what they have to offer. Obviously, I like my platform, but NASDAQ's a great platform too. That being said, we typically meet with companies 12 months in advance of them contemplating either the IPO or uplisting from the OTC markets. I'm going to touch upon other alternative public offerings, particularly reverse mergers, because I see a lot of those transactions. And I'll just say, as far as those transactions are concerned, we certainly invite listing those companies, but there are rules in place that companies have to adhere to that, unfortunately, both myself and my competitor have the same rule set. It's been very clear by the SEC is they don't want regulatory arbitrage between the two exchanges. Most companies, when they file the S-1, don't designate an exchange. However, that being said, we're typically aware that the company is going to be filing under the Jobs Act, and we've probably been meeting with them for 12 to 18 months in advance. A lot of companies ask about the listing process and about the filling out of the application. We at the New York Stock Exchange, if you file an S-1 to go public, there is absolutely no paperwork and no fee to be assessed when to begin the listing process. For companies who are currently traded on the OTC markets, we do ask for 2 documents. One is what we call an information request letter. Effectively, it's a questionnaire giving us information about the company's public history to ensure that it's always conducted itself in a manner suitable for the public arena. And 2 is an officer and director's worksheet. Once I receive those documents or the registration statement, I then go over to NYSE regulation. NYSE regulation reviews companies on 3 broad levels. One is quantitative compliance, quantitative being the listing standards, either MKT or NYSE. 2 is qualitative compliance, qualitative meaning that we do regulatory background checks on all officers, directors, 10% or more holders. We also submit the names to FINRA and the SEC for their review as well. And 3 is corporate governance adherence. What I'll say about corporate governance is that NYSE, MKT, and NASDAQ corporate governance rules are identical. The New York Stock Exchange, NYSE tier, they have 2 other provisions that we require. One is an internal audit function. And what do I mean by that is that we designate or mandate, I should say, that an individual at the company has the function of internal audit, and he or she has a direct line or dotted line to the chair of the audit committee. The second thing that we mandate, and I should say we mandate for both tiers, is that the CEO and the CFO sign a certification at the end of every year indicating that the corporate governance structure of their companies is in line with the exchange. Those are the only 2 exemptions or differences between my competitor and myself. So once a company is reviewed on those 3 levels, we then schedule to go up to what we call the Listing and Compliance Committee. It's a group of independent regulators at the New York Stock Exchange. We present, not we, but the staff level does, and they will concur that this company is suitable for listing. At that point, you'll receive a letter saying that you've been cleared to list. It could be NYSE or MKT, depending on where you qualify. Subject to. The subject to is now you submit the formal listing application and the supporting documentation. Now, one caveat is companies who need to execute a reverse split. We can begin the process without the company executing a reverse split so long as, 1, they get the necessary approvals, meaning whatever their charter and bylaws require, and 2, whatever the statement of incorporation requires. So, in order to begin the process, the company has to meet either numerically or on a pro forma basis the quantitative listing standards, or have in place to do a reverse split. The only thing I'll say about reverse splits is this. There are 2 types, and I'm not advocating for it, I'm just going to give you raw data points. There are 2 types of reverse splits. One is those companies who are trying to maintain something, usually i.e. a listing. Those reverse splits tend to have marginal lasting impact because although it fixes the share price, it really has nothing to do with the business model performing at a certain level. So it doesn't address the cap structure, it doesn't address the what I'll say, the business model. And the second type is a reverse split that's trying to obtain something, and that's usually a listing. In those cases, the business model is on the uptick, but what isn't working is the cap table for a variety of reasons. We've seen those companies who've done those type of reverses actually perform fairly well. Actually, today, we had a listing on NYSE MKT, a company called Energex Resources, who actually did do a reverse split, and post-split, stock is up about 18%. So, and interesting that the volume has actually picked up since then. So that being said, once you receive the clearance letter, two things can occur. One is we can begin the interview process with the designated market makers. There are 4 on the NYSE MKT. There are 6 on the NYSE. It's completely consumer driven, meaning you as the company or its advisor make that selection. It can be done in person or telephonically. Or you can defer to the exchange to make that selection. What do I say about the designated market makers is that big isn't better, small isn't worse. It really is consumer driven. And then secondly, once you submit the paperwork, and NYSE regulation reviews it, it's a good working order, we then give you the final approval. Now, if it's subject to an initial public offering, obviously it's subject to completion of the offering. If it's a company uplisting from the OTC markets, at that point, there's agreed upon commencement date, and we begin trading. What I'll say about ticker symbols is this, if you're an OTC company and you can maintain your current ticker, it's a portable ticker symbol, meaning it's your ticker symbol, not the right of the exchanges, or you can change it to a new ticker symbol. It's, again, consumer driven. As far as reverse splits are concerned, once you are cleared, we will then ask you to execute the reverse split. We monitor the share price for what we call a period of sustainability. Once we're satisfied that post-split, the share price has maintained its current level or is above our requirement, we then authorize you. So, is there a hard, fast rule? No, it's a period of sustainability. It typically runs about 10 business days. But it's certainly subjective, which gives us latitude at the New York Stock Exchange. All right, let me talk a little about reverse merge transactions. These rules were put in place, or I should say adopted, by both NASDAQ and the New York Stock Exchange in November of 2011. And effectively, what these rules are trying to curtail, or prevent, or have a company do is, if you go public through a reverse merge transaction, the company has to trade out and demonstrate that they can file on a timely basis 3 quarterly Qs and a 10K. Now let me give you some caveats to that. First off, the 10K has to encompass 365 days of NewCo. What do I mean by that? The company has a 12/31 fiscal year end, and they complete the reverse merge transaction January 1. That next year 10K would not suffice because it's only 364 days. So it has to encompass 365 days. So when people say, well, it's a 1-year seasoning process, unless you do it on the date of your fiscal year end, it typically is much longer than that. Now, what companies do, and what I advise them to do, is you can always change your fiscal year end to narrow that window in terms of timing. However, all of those filings must be done on a timely basis. If they're not done on a timely basis, it just extends the seasoning process, number 1. Number 2, once a company meets that seasoning process, in terms of filings, there's a part 2 to the rule. And what that part 2 is that the company has to trade for 30 consecutive days or 30 out of 60 above the listing criteria. Okay? So for the NYSE MKT, it's a $2 share price coupled with a $50 million market cap or $3. We'll get to that. But it has to trade above the listing standards before we can clear the company or accept an application. So most people think that it occurs the day that you file the 10K. In actuality, it's really 30 or 60 days after, depending on where the share price and where their listing standards are. Number 1, there is a caveat to it though, and some companies have taken advantage of it, and that is, at any point after you go public, if you file an S1 for a registered secondary offering, not a private placement, not a registered direct, but an S1 secondary offering, and raise $40 million, that at any point during that seasoning process, we can uplist you. And that goes for myself and my competitor. There is one other caveat. People have asked me, well, we went public to a reverse merger in 2005, would we still be subject to the seasoning rules? The answer is no. If you file 4 years of annual reports, the reverse merger rules no longer exist. depending on when you went public. All right, and this gives a little listing timeline. In total, the timeline for listing is about 6 to 8 weeks. I think the key takeaways here, if you're advising clients, number one, corporate governance adherence. 2, we cannot begin the process until you meet the quantitative listing standards. I know in the past, particularly at the Amex, where my competitor, exchanges were able to grant exemptions. Those exemptions no longer exist. Today, an issuer has to meet the quantitative listing standards. And if a company raises money, it has to be filed in an SEC report that they do meet the quantitative listing standards. So keep that in mind when you're advising companies or if you're looking to uplist on an exchange. Listing fees, I think one of the misnomers about listing fees is that most people perceive the NYSE to be a more expensive endeavor. The fact is, when I compare NYSE MKT to NASDAQ capital markets, they're identical, and in some cases, on an annual basis, it's actually lower. The way it works is during the listing process, once you are cleared for listing, for the NYSE, we require a $25,000 payment. For the MKT, it's a $5,000 payment. And then once you commence trading, we invoice you for the difference. Those amounts are deducted from the original listing fee. And then annually, in January, just like my competitor, invoices go out. Those are the only 2 fees associated with listing on an exchange. I will say that we do charge for the issuance of additional shares. So if a company is instituting an ESOP plan or any other type of issuance, we do require those shares to be listed on the exchange, and there is a fee assessed for that. We charge a little differently than my competitor. What I'll say is, we charge 2 cents per share, and we cap out at $65,000 per year, not per event. It's a little different than my competitor. Quantitative listing standards, what I'll say about this is, it is of no material impact to us what standard a company meets. It's a series of either-ors, both on the NYSE tier and on the NYSE MKT tier. And I can certainly go over it, but I'm going to focus a little more on the MKT, and I'll give you some bright line tests. 1, distribution, 400 holders. We look at beneficial, not record. And 2, we do include odd lot shareholders, those holders who have less than 100 shares. As far as the listing standards are concerned, standard number 1 is an income test. If the company is not profitable, we simply go to standard number 2. Standard number 2 requires $15 million in market value of public float. How do we make that determination? We look at the total shares outstanding minus the insider position. That net number we multiply by the share price. It comes up with a market value of public float. $4 million in U.S. GAAP shareholders' equity, and the share price is $3. We do look under U.S. GAAP, meaning that we don't exclude goodwill. Don't take out derivative accounting liability. Whatever the U.S. GAAP number is what we look at. If the company doesn't have a $3 share price, we simply go to standard number 3. $2 share price, $50 million market capitalization, $4 million in U.S. GAAP shareholders' equity, and $15 million in market value of public float. If the company, for whatever reason, is not showing shareholders' equity positive but has a deficit for a variety of reasons, go to standard number 4. The requirement is a little more stiffer, but it's $75 million in market capitalization. And the way we determine the market cap, TSO multiplied by the share price. Simple as that. Coupled with $20 million in market value of public float and a $3 share price. I'm not going to go through the continued listing standards. The only thing I'll say about this is on the MKT, there's no minimum bid price requirement. We look at shareholders' equity and years of losses rather than looking at bid price. My competitor looks at bid price. There you go. I'll certainly can answer any questions that anyone might have. If not, I really appreciate the opportunity.
Don't run anywhere yet. I just have a couple items to go over.